Good morning. How are we doing? I trust that we are well. So yesterday we were discussing on ratio analysis, and we say ratio analysis help us to understand or measure the performance of the organization, because maybe tomorrow you might be an interested investor and you need to understand whether the organization you want to invest in is doing well, is growing, or it is not. And one of the way we can be able to measure that is when we use ratios. So yesterday we were able to handle the liquidity ratio. So today we are going to handle the solvency ratio. And solvency ratio, it is just the ability of the organization to be able to meet its long-term obligation. And this ratio, it measures the debts in a company structure and evaluates its ability to generate sufficient earning to cover interest payment and debts. It weighs or it measures whether the company is in a position to repay back their debts and also to repay the interest plus the interest. So one of the ratio that we are going to start with, number one, is we're going to start with debts to equity ratio, and it is calculated by total debts divided by total equity. So on this ratio, it focuses or it compares the total debts to its shareholders of the company. It indicates a proportion of financing from the creditors and from the shareholders. It just compared out of the asset we have bought in the organization, or out of the funds we have in the organization, how much is for creditors, how much we did a loan, and how much are coming directly from the shareholders for our organization. So it is just that comparison to understand at what position are we as an organization. Are we leaning too much on the debts, or are we focusing on the equity or the money that is coming from the or are we basing or focusing on the being financed by the shareholders? And that is it. So we can go into calculation to calculate and see on how this being calculated. So this is just a continuation of what you were doing yesterday, this question that had a balance sheet and what do you call it, and the income statement. So on debts to equity ratio, we said debts to equity ratio is equal to total debt. Let's come here. Please remember that we are focusing for this, we are focusing on long-term sustainability in terms of debts and equity. So in my calculation, I'm going to focus on the long-term debts. So it is long-term debts divided by total total equity, total shareholders equity profit. Then on debts ratio, okay, we can. Okay, we can have that one. Then number two ratio, we have debts ratio. And just before we continue on debt ratio, so debts to equity ratio, we have said we are now analyzing where our financing is coming from. Are we taking loans, or is it coming from the shareholders? So a higher debt to equity ratio suggests a higher degree of leverage or financial risk. So if we get that debt to equity ratio, we find that debt is higher than equity. So it is a financial risk where the company is focusing or is relying more on borrowing. Yes, which is not good. Yeah, so that is how we make judgment in terms of that. Maybe, yeah, that is how we make judgment in terms of that. So debt ratio. On debt ratio, we say it is the total, the formula is the total assets divided by total, it ought to be the total debts divided by the total assets. So on this, maybe just before we go into calculation, it measures a proportion of the company assets that are financed by the debts. It indicates a percentage of the company assets that are funded through liabilities. So for this one, it just measures what do we call it? It measures, okay, it is analyzing, you analyze your assets, then you weigh, how have we bought these assets? Is it through loans or is it funds that we had in the organization? So this one, just compare that. And when we get a higher of the debt ratio, it indicates a large proportion of assets being financed by the debts, which is also a finance risk. It ought not to be so. It is an example, practical an example is like our day-to-day living. If you picture just on how you carry out your things in the house or just in your life, and you find out that like you're spending 90% of the things you have acquired are from the debts, and you're trying to weigh now in between trying to pay debts and also the interest. So, and when you calculate, the debts are higher than, okay, whatever is being financed in your life in terms of debt, in terms of loan, is higher than the cash, the liquidity cash that you have. That implies it is so risky because the sustainability of that one, it is not guaranteed. So in calculations, so we say debts to equity ratios. So we come here and please remember that on solvency ratio, it assesses the company long-term financial stability. And that is why in my calculation, I'm more interested in long-term debts. Please take that into, please mark that. So it's equal to, we said it is total long-term debt divided by the total non-current asset, the total assets. So this one measures on, just as I have explained, on how much or the portion of amount of our assets that were financed by the debt. So, and we said if it is higher, it implies that or indicates that most of the assets are being financed by debts in our organization, which is a finance risk. So number 3, we will talk about interest coverage ratio. So on interest coverage ratio, on this one, the formula is EBIT EBIT divided by interest expenses. So on this, let me not assume EBIT stands for earning before interest and tax divided by interest expenses. So on this, the interest coverage ratio assesses a company ability to meet its interest payment on outstanding debts. We are all aware that when you take a loan, there is an interest that someone need to pay. So on this ratio, it helps us to analyze and understand whether the organization is able to meet and pay its interest that on the loan they took. So in this, how we calculate is EBIT, interest before it is earning before interest and tax divided by interest expenses. So here is how we will be able to calculate it. So it is EBIT, where is EBIT? EBIT divided by interest expense. Okay. Number 4 ratio, in terms of solvency ratio or leverage ratio, we have debt service coverage ratio. And for this one, let me write debt service coverage ratio. So on this one, it evaluates the company ability to be able to meet its long-term debts and be able to pay their interest. And it includes both the principal and the interest payments. So on this one, in fact, solvency ratio is easier because you only focus on you comparing your debts, interest, debts, total assets, and debts, whether we are able to pay it together with the debts itself and the interest. So on this one, we will calculate it by using EBITDA divided by total debts service. So it just indicate whether the organization is able or in a position, okay, EBITDA. Okay. So what I mean by EBITDA, it is earning before interest, tax, depreciation, and amortization. Earnings before interest, tax, depreciation, and amortization. Okay. So it is earning before interest, tax, depreciation, and amortization divided by the total debt service. So when it comes to calculation, this is how we will be able to calculate it. It's equal to, we said it is earning before, okay. So here we have earning before interest and tax. So we'll say it's equal to this one. Let me maybe say into brackets. Then this one, then we add back whatever we had subtracted, and that is depreciation we had subtracted. Then divide by into brackets. We said it is interest expenses plus our long-term debts that we need to pay. So it is the total debt service. And remember, debt service, are we servicing? We are paying back the debts, the amount, the principals, and also the interest. That is what we get. And have two. Okay, so on solvency ratio, that is how we ought to calculate. In case you have any concern or a question regarding to this, please feel free to chat so that you can see on how to help each other, so that we can, we gain knowledge from each other. So on profitability ratio, we can start and see how far we can handle this. So we have profitability. So on the profitability ratio, it assesses the company ability to generate profit and measure its overall profitability. This ratio helps evaluate the company operational efficiency, effectiveness in managing costs, and ability to generate returns for each shareholder. Here are some of the common profitability ratio. We have gross profit, we have net profit, then we do have return on assets, then we have return on equity, operating profit margin, and yes, we have 6. So we will be able to calculate 6 of the profitability ratio analysis. And what have we said on profitability ratio analysis? It just measures the ability of the company to generate profit and measure its overall profitability. Very simple. Measure, it is the ability of company to generate profits and measure its overall profitability. So on this one, we will start with something we call that everyone is aware of, gross profit. How do we calculate it? Is equal to gross profit divided by sales and 100%. I hope you can see my formula here. We have gross profit divided by sales times, not 1,000, I'm sorry. It is 100%. Okay. So on this one, on gross profit margin, measures the percentage of revenue that remains after deducting the costs of goods sold. I know, guys, we understand how we normally do calculate on how we ought to calculate for us to come to the answer of gross profit. And normally it is the sales stock or either the revenue, then we subtract the cost of sales, then we get down there it is, let's just go to the income statement and see how we do calculate this. So it is the sales which is the cost of sales, then we get this one. So for us to calculate the ratio of it measures the percentage of the revenue that remains after we ought to have paid this. After we paid this, we want to understand the ratio that remains. And we'll come here and say is equal to, we have this amount divided by this times 100%. My formula is here, guys. Yeah, so that is it. It is gross profit itself divided by the sales times 100%. So that is it. Then we come to calculate the net profit margin. On the net profit margin, so we have net profit margin. On the net profit margin is equal to net income. No, net income divided by net sales times 100. So on this one, the net profit margin represents the percentage of the revenue remaining after deducting all the expenses, including cost of goods sold, operating expenses, interest, taxes, and all the expenses that the organization have. Here we go. So we have, normally it is income, this one. Let me just highlight it. Okay. So for us to be able to calculate this ratio, the ratio, for us to be able to calculate the net income ratio for the organization, at the net profit, whatever margin, it is the net profit margin, we ought to calculate, we have the sales that we had, minus all the expenses, the office expenses, tax expenses, other expenses, depreciation. After getting this amount, now here, it's where we will come and say, this is what remains after removing all the expenses the organization have times 100. Yeah. I said percentage, I need to ought to put here percent. Okay, so that is it. So that is for net profit margin. So the higher the net profit margin indicates a better overall performance of the organization, profitability and effectiveness of cost management in the organization. If we have a higher, so it means the organization is in a position to manage on what they are spending, on cutting on costs, and just to moderate on cost management of the organization. Then here we will come to a return. Number 3, we'll calculate the return on assets, or at a time it's called, into brackets, ROA. So on return on assets, it measures the company ability to generate profit from its asset. It evaluates the efficiency of asset utilization in generating earnings. So this is how we calculate it. It is net net income divided by average. Please remember it is average total asset. And we said for this one, it measures the company ability to generate profit from its asset. It is now weighing in that organization of yours, is whatever the asset you're having generating income. And this is how we'll be able to measure it. We will come, and the formula we have said, it is net income divided by average total asset. So for average, anything to do with average, you do not start with the beginning year. You start with the following year, because you need to calculate the average between the closing year and the opening year for you to get the difference. If you use the beginning or the opening year, it will be so hard for you to calculate the average. What I'm trying to say, it is here. Please look. We say that return on asset, we will calculate by, it is net income divided by, please, here is my formula here, up here. You can see my formula from up here. Divide by average. I will just insert the formula of average. What do you call it? We said it is average total asset. Average total asset. So average total asset, we will check the total asset for 2017 and total asset for 2018 for us to be able to get the average. And that is why I said when you are calculating anything to do with average, you start with the following year, and we'll start with 2018. So it is this one. We just, okay. Here's my formula, guys. Here is it. So it is net income divided by the total assets. This is what you get. Okay. Then here we will come and calculate the, what do you call it? Return on equity. Return on equity. So on ROA, that is return on asset, a higher return on asset suggests a better utilization of the asset to generate profit in the organization. If it is higher, it means we are making good use of the asset that we have to generate income. If it is lower, it means we are not doing our best to do that. So we need to, for decision making, they need to look into that. So on return on equity, this is how we calculate, is equal to net income. Then we divide by average total equity. So on this one, it assesses the company ability to generate returns for its shareholders. It indicates how effectively the company utilizes shareholders' equity to generate profit. It just measures on how the organization is using the shareholders' equity to generate income. And this is how we will be able to calculate it and measure it. It's equal to whatever the income we have, divide by average net total equity, total shareholders equity, this one, to brackets. Okay. Then return on capital employed. Number 5. Return on capital employed. So return on capital employed, Most of the time it is called, it is ROS. Okay, let me just write it here. Return on capital employed. And it measures the return generated by a company capital investment. It assesses how effectively a company utilizes its capital to generate profit. It is how the company utilizes its capital to generate profit. And this is how it is being calculated. It is BIT divided by, into brackets, total assets minus current liability. Okay, we can do this one, the last one, then we meet in the next lesson as we finalize on this issue ratio, in this matter ratio. So return on capital employed, it is total asset, EBIT, divided by total asset minus current liability, guys. So let's do it very fast. We will start from the first year because it is literally not it is not an average thing. So it's equal to EBIT. Where is EBIT? This one. Then we divide by, into brackets, total asset for the first year. We remember it is up here. Total asset minus current liability. We go to total current liability. Current liability. Okay. That is it. Okay, so yeah, that is it. So on the operating profit, it is a homework. Guys, try to calculate whether you can find the operating profit and the formula for operating profit. So let me just write it here. The formula for operating profit is equal to operating income divided by net sales times 100. Please try and calculate that one and see whether you can be in a position to get that. Then we meet in our next lesson. Thank you and have a good day.